Welcome to this explainer, where we're going to dive right into the fascinating and honestly sometimes frustrating mechanics of the unseen crypto market. Okay, so we are going to unpack a mystery today that has literally baffled retail traders for years. Have you ever wondered why massive headline-making Bitcoin purchases by major institutional players almost never seem to immediately spike the public market price? If you've ever sat there watching a huge accumulation announcement drop on Twitter, fully expecting a massive green candle, and instead you watch the chart do absolutely nothing, well, you are definitely not alone. Today we're going to totally demystify the invisible infrastructure that makes that happen.
I want you to just think back on your own experiences for a second. Have you ever seen Bitcoin or even a traditional asset like gold move incredibly sharply right after a long, agonizingly silent consolidation phase? You absolutely know the feeling. You're staring at this incredibly boring sideways chart for weeks. The volume looks completely dead, retail traders get frustrated, they look away, and then boom! Out of nowhere, the chart explodes, leaving pretty much everyone feeling like they missed some secret signal. So the core question we have to ask ourselves is, what was actually happening during all that silence? The answer isn't that the market was just asleep, it's that the real action was happening somewhere you couldn't see.
To really understand this, let's look at what we can call the Michael Saylor anomaly. I mean, we've all seen the headlines, right? Michael Saylor and MicroStrategy announced they just acquired hundreds of millions of dollars worth of Bitcoin. Retail traders immediately pull up their screens, bracing for a massive face-melting pump in the public price, only to see a totally delayed or sometimes totally non-existent immediate reaction. How is it mathematically possible to buy that much of an asset without the price skyrocketing instantly? Well, it all comes down to exactly where and how that buying actually happens. Because, spoiler alert, they aren't just logging into a standard retail app and clicking Market Buy, they're operating in an entirely different venue.
So, what is this mystery venue? It's called a dark pool. Basically, a dark pool is a private liquidity venue where large institutional players can execute massive orders without immediately affecting the public market price. Now, I know the term dark pool sounds incredibly sinister, right? Like some smoky backroom conspiracy where the elites control everything. But honestly, it simply refers to pre-trade opacity. That's a fancy way of saying the order books, the exact lists of who is buying and selling at what price, are just not broadcast publicly before the trade actually happens. It's really just a completely necessary off-exchange forum so that big players can move massive amounts of capital without completely tipping their hand to the entire market.
Think of the market literally like a giant iceberg. The tip of the iceberg, the part above the water, is the public order book. It has high visibility, which is great, but because of that, large orders cause an immediate price impact and high slippage. If an institution tried to buy $1 billion of Bitcoin up there, they would eat through every single sell order, driving their own purchase price higher and higher. Nobody wants that. But underwater, that's where we find the dark pools and over-the-counter or OTC desks. Down there, we have hidden liquidity, a delayed price impact, and crucially, reduced slippage. Institutions can quietly match massive blocks of crypto directly with each other, keeping their average entry price completely stable.
Understanding this hidden liquidity completely changes how we should view market evolution. There's a great concept we drew from insights by platforms like GoQuant and their Go Dark offering. Institutional trading infrastructure like dark pools is actually maturing the crypto market. It's bringing Wall Street-style mechanisms into digital assets. We really need to shift our mindset away from these internet conspiracy theories. Dark pools are essentially just boring, necessary market plumbing. Without them, large firms simply couldn't participate in crypto without destroying the very markets they're trying to invest in. So really, they're just a sign that the crypto market is growing up and getting ready to handle serious institutional capital.
Okay, let's break down the actual anatomy of one of these institutional trade cycles step by step, so you can see exactly how these sudden large moves materialize on your screen. Step 1. Quiet accumulation. The institutions are quietly filling their massive orders in the dark pools. Step 2. The controlled price range. If you look at a daily chart here, the candles just look entirely sideways and boring because the heavy buying is off exchange. Step 3. A liquidity trigger hits. This might be a big public news event or simply the completion of the institutional order. And finally, Step 4. The sharp breakout or dump. All that unseen tension finally snaps into the public market, printing those massive green or red candles that catch everybody off guard.
So how does this unseen plumbing translate into what you actually see on your charts? Think about the consolidation phase. The volume appearance on a public exchange looks incredibly low. It's quiet. And because of that, the retail perception is that the market is dead, boring, or everyone's just losing interest. But if we look at the institutional action during that exact same time, it's heavy, off-exchange accumulation. The public volume is literally masking the reality of the situation.
Retail traders end up getting chopped to pieces trying to trade a tight, unpredictable range, or they just get completely bored out of their positions entirely, right when the smart money is quietly loading up their backs.
Just think about the sheer visual scale of the discrepancy here. Imagine comparing a tiny little representation of the visible public volume against a towering, massive amount of hidden institutional volume during one of these consolidation phases. The volume being transacted through entities like OTC desks and specialized institutional infrastructure absolutely dwarfs what retail traders are seeing on normal everyday public exchanges. If you are only making your trading decisions based on that tiny visible portion, you are missing the vast majority of the true market context. It's like trying to put together a puzzle when you only have 10% of the pieces.
So what exactly happens when all of this finally spills over? We get what's known as the after effect. Now this is an absolutely crucial concept. Because retail traders just don't have access to real-time dark pool data, they usually only experience the market on a delay. When the unseen accumulation finally finishes up, and the true supply and demand dynamics suddenly hit the public order book, the price violently adjusts. That sudden 10 or 20% spike in Bitcoin? Listen, that's not the start of the institutional buying. That is the after effect of weeks, sometimes months, of hidden accumulation suddenly being priced into the public market all at once.
So, how do we translate all of this into a personal strategy that actually works? How do you survive and actually thrive in a market that is heavily influenced by unseen forces? First rule, do not try to predict the dark pool. Overcomplicating your trading with hidden assumptions and wild conspiracy theories is literally only going to lead to losses. Instead, focus entirely on observable price action. Wait for clear confirmations on your chart. Look very closely for liquidity sweeps. You know, those sudden, sharp dips designed to trigger retail stop losses and grab available liquidity right before the price violently reverses? That observable structure, that is your footprint. You don't need to actually see the invisible monster. You just need to trade based on the massive footprints it leaves behind in the public data.
Which brings us to our final, essential question for this explainer. Are you going to keep trying to predict the unseen dark pool, endlessly guessing what the institutions are doing behind closed doors? Or are you ready to master trading the observable aftermath? The market definitely has hidden depths, there's no denying that, but the monsters always leave footprints. Next time you see a totally dead, boring sideways chart, I want you to look past the low volume and ask yourself what's really happening underwater. Keep your focus sharp, watch for those footprints, and I'll see you in the next explainer.